Welcome everybody to the call this morning. Today we have an exciting guest. We have Rufas on call. I can see him already. He's ready to get started. But again, before we even invite Rufas to say hi, I just want to say, thank you for everybody who's joining us today. This is the first Catapult series for 2022. 2022 will be a big year for us, but also we expect it to be a bigger year as well for crypto and the space. Despite the current market drawdown, I know a lot of us are still wondering what's going on, but again, on a macro level, we believe that the space continues to grow and to expand. And the enthusiasm, obviously, even in the room, as I can see, is evidence of that. But at the same time, also, we realize there are a lot of opportunities out here as well for a lot of us, even in the crypto space. And I think Rufas is one of the people in the space that personally I respect. And also, a lot of you also may be well familiar with his work. And today he'll be speaking to us really about, traditional finance, TradeFi, and DeFi, decentralized finance. What are the differences? What are the similarities? What are the opportunities within both of these spaces? So I believe that gives us a good, well-rounded knowledge so that we can make informed decisions when it comes to investments. And I think without much ado, let me just call in or invite Rufas to speak. Hi, Rufas.
Hi, David.
Yes, nice to see you again. How you been? Great. How's 2022 coming along for you?
So far, not very nice. We all know what's happening in the markets. Bitcoin down, crypto down, stocks are going down. So it's not very nice, but we know that good things are coming up.
Yeah, definitely. I mean, so these market conditions do happen. And I think you are in a much better position to actually talk to us about that and what's going on. And I think I'll just let you take the floor and, take us through these two spaces. And before you continue, I'd just like to ask if you have any questions, please type them. Rufas will be happy to answer them after his presentation. So just ask any question around DeFi, around traditional finance, investments. So again, Rufas, welcome. The floor is yours.
So hello, everyone. I'd like to start with a brief introduction. So for those who don't know me, I'm Rufas Kamau. I'm a research and a markets analyst. I mainly deal with forex. I do a lot of forex education. At the same time, I deal with stocks, ETFs, and other financial instruments. So I'm currently working with Scope Market, which is a local financial markets broker. And what we offer is a trading platform that facilitates you to access a lot of global financial markets. And this includes shares. We also look at currencies, commodities, as well as futures and ETFs. So I also do trainings, daily trainings, trainings about market analysis, understanding the market, introduction and stuff. So for today, I'll be looking at a comparison between DeFi and traditional finance. So for those who don't know what DeFi is, don't worry, this is a beginner level session. So we'll be looking right into the introduction, look at the definitions, the differences, the players, and it will literally help you understand what DeFi is, what traditional finance is, and how you can participate. So I'd like to begin with a disclaimer that this is not financial advice, and any products that we might mention in the presentation is not a recommendation. So you'll have to do your due diligence. If you're looking for investment advice, then you should probably look for a professional or do further research and make the decisions yourself. So that aside, I would like to start right away. And I have nice presentation here. So let me hear from the comments if you can see my presentation. Awesome, awesome, awesome. Thanks guys for the responses. I always appreciate these. So if you have any questions arising from the presentation, don't be left aside. Feel free to type in the Q&A section. I'll be answering these questions right away. So let's get on with it. So decentralized finance is basically a short form for DeFi is a short form for decentralized finance, which is an emerging financial technology that is based on secure distributed ledgers, or what you call blockchains, which is similar to those used by cryptocurrencies such as Bitcoin, Ethereum, and so on. So the system removes the control of banks and institutions have on money, financial products, and also financial services. And this is a definition from Investopedia. So whenever we talk about DeFi, we are talking about a new form of finance that literally copies everything from traditional finance, but now removes the function of central banks, the need for commercial banks, and all that. And what this literally does, it removes the difficulties that were there to entry. So for a lot of people in the world who had difficulty in accessing banking and banking facilities, now they're able to do so from the comfort of their home at an arm's length, that is from their smartphone, from their laptop, and so on. So the notion of DeFi is gaining traction as new technologies such as Web3, blockchain smart contracts, and cryptocurrency become more widely adopted. So DeFi fundamentally alters our approach to financial products. And this is what we'll be mainly focusing on today. So unlike the old financial system, and when we talk about the old financial system, it's not something that was happening some time back. It's actually the current financial system that we are having right now. So the current financial system where we have fiat currencies. For those who don't know, fiat currencies are basically the currencies that we use, the hard currencies. So from fiat currencies going to central banks for each and every country, going to commercial banks and other financial institutions, they are all included in the traditional financial system or the current financial system. And where we are headed for going forward will not be having those institutions. So unlike old financial system, which is based on a centralized platform governed by government agencies and other intermediaries, DeFi is based on a protocol that runs on a decentralized network powered by blockchain. And this is mainly Ethereum. This was the very first platform that made it possible for people to develop DeFi products. So as a result, programmers may create personalized, efficient, and secure financial platforms that are accessible to anybody with an internet connection and a computer. So from this graphic, right from my first slide, you can see one of the major differences between DeFi and traditional financial system. So the traditional financial system basically has a lot of intermediaries. For instance, let's say you want to send money to some guy in Brazil. In this case, you'd have to go to your local financial bank or commercial bank, let's say Equity Bank or KCB, and then transfer that money via a payments processing platform. This could be Visa or MasterCard. You could use Venmo. You could load the money to PayPal, and then you send that money to the account number of the recipient. Then, once the recipient gets the money, let's say to their PayPal account, to their Venmo account, then they transfer this money to their commercial bank, and then this person goes to the commercial banks and then withdraws the money in cash. So that's the usual process. And if you look at it clearly, you'll notice that there is a cost for each and every player in the market. So from your local commercial bank, going to the Visa, PayPal, Venmo platform, going to the foreign commercial bank, all of them will be taking a cut of the transfer, and then the recipient will receive a smaller amount of money because there is some in-between players who participate and gain from that. So what DeFi is doing, it's making it easy for you to transfer your money from one person to another person permissionless. In this case, you don't need any permission. There is no regulator whatsoever. So you have total control of your money. You can decide who to send your money when. And also, when you look at the transaction costs, they are minimal. unless, of course, if you are using Ethereum. We know that the gas fees are way high when you're using the Ethereum platform. So in that case, the transaction cost might be significant. But if you're using other chains, then it's usually a very small amount of money. So if you look at examples of DeFi platform, you'll notice there is what we call AAV. Sometimes it's pronounced as AAV. Some other players will call it AAV or AAV and so on. We also have another platform called PancakeSwap. This one works on the Binance Smart Chain. We have Yarn.finance, we have Uniswap on Ethereum, we have Compound, we have Curve Finance, SushiSwap, Venus Protocol, and also Balancer. So I'll be looking at these individually, showing you what is this platform, what does it do, and how does it facilitate the DeFi ecosystem. So alternatively, now we look at the traditional finance, and this is what I normally do on my day-to-day work. So I mainly deal with this traditional finance. It's not something in the past, it's a current thing, and it's not a do or die thing. It's not an A or B. So it doesn't mean that you have to either go to DeFi or to traditional finance. You can develop a mix of both or select one based on your own interest. So traditional finance is a broad term that describes activities associated with banking, debt, credit, capital markets, money, and investments. So basically, traditional finance represents money management and the process of acquiring the needed funds. Traditional finance also encompasses the oversight, creation, and study of money, banking, credit, investments, assets, and liabilities that make up our centralized financial systems. So traditional finance is largely regulated by the central banks of each and every country. So if you're in finance in a country, then there will be a central bank regulating that currency. And also we have what we call the capital markets authorities. For instance, in Kenya, we have the Capital Markets Authority of Kenya, or CMA, which regulates and licenses all capital markets players within the jurisdiction. So if you look at scope markets as a financial market broker, it's regulated by the Capital Markets Authority of Kenya. So if you go to the US, you'll meet what we call the Securities and Exchange Commission, or SEC. And if you move to other jurisdictions, the UK, each and every country will have its own regulatory body. So to access traditional finance, one is required to have a commercial bank account and also a mobile banking wallet, which is where we are headed based on the current developments in financial technology, or what we call fintech. So when you look at traditional finance, we know that it's highly regulated. So to access, let's say, a financial product, you'll need to have a bank account. You'll need to get that verified. You need to register with your ID number, your KRA PIN certificate and stuff. But with DeFi, you notice that access is very simple. You don't need all that. Probably what you need is an ID number, a phone number, and an email, and that's it. You have complete access to a whole new financial system. So in this session, we shall look at the main differences between the two models of finance. We look at similarities, opportunities, and also the risks involved. We shall adopt the perspective of a young Kenyan who is looking to achieve financial independence. So yes, this webinar is for learning purposes. So we'll put a lot of focus on young Kenyans. I believe that most of you guys are young. So the goal is to achieve financial independence. So the perspective will not be on, let's say, developing these systems. We are not a coding community. My main perspective is in terms of investments. So if you're looking to build a portfolio, an investment that gives you some better than average returns, then this is the right platform for you. So examples of traditional finance assets include the following. One, we have cash. This is very simple to understand. This is simply the fiat money that you use to buy goods and services. We also have equity. Equity basically refers to ownership. So if you are looking to own a company, then you buy equity products, and this includes what we call shares of various companies. We also look at exchange traded funds, or ETFs, and also what we call index funds. So at the same time, there is what we call fixed income, and this is basically referring to bonds. Literally, when you lend your money to the government, in this case, we refer to this as a bond. So you receive a bond certificate, and when the government pays you back the money, pays you with some coupons that you get to enjoy as the benefit for investing with the government. We also have what we call REITs, Real Estate Investment Trust, or real estate. So we know that traditionally, for you to invest in real estate, it was very difficult because it's very capital intensive. So you'd have to have a lot of money to buy land, develop that land, and then sell the products. But right now, with current developments in fintech, you can literally buy one share of a REIT or real estate investment trust. One share could be, let's say, 10, 20, 50, $100, and then you get to benefit from that. If there's growth in that sector or in that individual company, then you get to benefit by that by investing in those stocks in the real estate companies. At the same time, we have what we call commodities. So you can basically participate by trading global commodities such as silver, we have gold, crude oil, copper, among other commodities. So those are examples of traditional financial assets. So now we focus on the differences. And as I already mentioned, if you have any questions, don't be left aside. Feel free to raise those questions. So a very next question from Edward is Binance not a DeFi platform? Yes, definitely. Binance is a DeFi platform. It's one of the most instrumental platforms for you to join the DeFi space. So if you're a Kenyan, you're looking for a point of entry into the cryptocurrency world, then most probably you go the Binance way, then from Binance you venture into other products. So it's definitely a DeFi platform. So one of the major differences in DeFi is the currency issuer. So the organization or body that issues the currency is different when you compare traditional finance with DeFi. So in DeFi, currencies are often referred to as tokens are issued through minting. And I'll explain what this means. So if you are in DeFi space, and here we are talking about tokens. So I'll begin with Bitcoin, which is the original currency that was based on a blockchain. So Bitcoin is a digital currency that helps you send and receive money anonymously and also in a permissionless way without a central body organizing the activity. So after Bitcoin, there was a need for more functionality in the blockchain sector, and this is how Ethereum was born. So Ethereum was the very second chain that came up with more functionality from the Bitcoin blockchain. And with Ethereum, we had what we call smart contracts. So smart contracts are basically small batches of code on top of a blockchain that help you execute functionalities on top of the blockchain. So these smart contracts help aid the development of what we call DApps. So DApps is short for decentralized applications, and these ones are run on a blockchain. And the DApps are what makes the DeFi space possible. So all decentralized finance protocols are based on DApps, and the very first one was developed on the Ethereum blockchain. So when you are looking to create a DeFi platform, the very first thing that you need to do is to find an existing chain. Yes, you can start from the ground, build your own chain, which is very difficult. But if you find an existing chain, such as Ethereum, Solana, Cardano, then you can build a platform on that. So when you build that DeFi platform, it will have to serve some form of functionality. This could be an exchange, either a centralized exchange, a decentralized exchange. It could be a platform that helps in banking. We have the DAOs and so on. So whatever the platform that you are looking to create, it will have some form of solution that you're looking to fulfill. And in that case, you code it on an existing platform. So the smart contracts will specify through code how many coins will be minted and how often. So if you create a new coin right now, you'll have to define that this is the total number of coins I want to have in circulation, and this is the manner in which they will be minted. So from that smart contract, it will define how many coins are created, how often, and the events that trigger the creation of those coins. So that's basically what we mean by minting. So they will then distribute these tokens to the community through various methods. One is a very common method called a pre-sale. So if you develop a DeFi platform, you do a pre-sale. A pre-sale, you basically look for early investors, and these early investors will basically invest some money, lock the money in there to help you develop the project. And once the project grows, then they will be able to redeem their invested money. So at the same time, you can do an airdrop. Airdrop is basically giving people free tokens that they can use to redeem on the platform or to serve the functionality of the DeFi platform. So an airdrop is very simple to understand. We all know how airdrops are done for, let's say, relief food. So traditionally, when let's say you wanted to give relief food, a plane would fly around the area where there was a scarcity of food, and then they would drop the food to the people. So an airdrop kind of functions in a similar manner, where if you have a community and you are looking to give them tokens of a platform that you are building, then you basically distribute those tokens to them based on some predetermined logic. So you can also do a marketing campaign where you give people tokens based on their activity. So this is the most common way of distributing tokens right now. So you'll find several groups. Let's say some people will share your product through their social media. So you reward people for doing the campaign for you. So if people, let's say, are sharing about your product, they are writing articles, they are doing videos about your product, then you reward them with tokens, and then you build from there. So it can be grouped into several sectors. You can do a social media campaign. You can look at coding, help look at developers when they debug your software or your platform, then you reward them with tokens and so on. We also have what we call initial token offerings. An initial token offering will be basically a package offering a new token in the market. And this is often done using what we call a launchpad. So you might find a third platform that serves as a launchpad. It will help you organize all these activities from the pre-sale, airdrop, campaign, initial token offering as one product, and then they help you launch seamlessly. So rather than doing all the work, you focus on your main product, and then that particular company does that for you. And also we have what we call a direct sale, where you basically create a product and then you sell it to the people. So based on the usefulness of the product, then it's going to have some demand, people buy that product, and then they start using it right away. So for most DeFi platforms, this is how they get started on the markets. So if you look at traditional finance, currencies are created by central banks. So if it's the Kenya shilling, it's all printed by the Central Bank of Kenya. So it's the Central Bank of Kenya which will determine the total amount of currency in circulation. If there is need to print more, they'll print more, add that to the circulation in the market. And if the currency is in excess within the economy, then they can do some monetary policies to reduce the amount of currency within the economy. And this can be done in several ways. We know that there is a raising and lowering of interest rates, and all these are what we call monetary policies. They can issue a bond where they literally borrow from the economy and in a process called open market operations. So if you want to learn more about bonds, I believe one of the best websites you have in Kenya is the CPK website. So if you go to the Central Bank of Kenya website, then you're going to see all the description for bonds and how they do their monetary policies. So in both cases, the currencies are used to buy goods and services and also as a store of value. So if you do some work, let's say I work somewhere and then I get paid in Kenya shillings, that payment is basically a store of value, evidence that I've done some work, or in crypto terms, we call that proof of work. So if you own something, then that is usually described as a proof of stake. But if you have done some work and you want to store that value, then it's definitely referred to as a proof of work. And this later develops into two different platforms, proof of work platforms and also proof of stake platforms. So for most DeFi platforms, they will be based on a proof of stake platform. Or basically evidence that you own something. So currencies are the key pillar to any form of finance, be it DeFi or traditional finance. So without a currency, you'll not be able to execute any kind of transactions. So it's the basic or the bottom line for all platforms. So currencies can be what we call inflationary or deflationary in nature. Uh, An inflationary currency keeps increasing the amount in circulation over time, while a deflationary currency either has a hard cap with increasing demand or has a decreasing supply over time. And I'll explain what this means. So if you have, let's say, an inflationary currency, and this is what we literally have in all major economies, it means that the amount of currency in circulation keeps on increasing over time. So if you look at all the Kenya shillings available in circulation in the Kenyan economy, if you check this again next year, same period, then you realize that the number is increasing. And the main reason is because the commercial banks will keep on printing money. And whenever you hear of inflationary growth, it means that the amount in circulation keeps on growing while the value keeps on going down. And this is a major concern for major participants in the market, and it's one of the fuel that drives the DeFi in the blockchain space. So with inflation, it means that if you keep your money in terms of, let's say, Kenya shilling, and you don't do anything with that money, then it's definitely going to lose value because the amount in circulation keeps on growing. So to make it very simple for everyone, if you, let's say, have a pot of tea, you're preparing a pot of tea, you have your milk, you have your water, and it's boiling. Let's say this tea is the size of, let's say, 20 cups. So in your pot, you have 20 cups of tea. So if you add some water, just 1 glass of water into that tea, now you have 21 cups. So if you fetch 1 cup, you have 1 extra cup. So that's literally how the inflation happens. When you print more money, you don't print more value. What you're actually doing, you are stealing some little bit of value from each and every other cup. So if you add some water into, let's say, 20 cups of tea, and then you fetch your extra cup of tea, you have not created an extra cup of tea, you are actually stealing some value from each and every other cup. So in this case, if you add 5 cups, 5 glasses, then you are literally dissolving the tea. It gets poor in quality. So the same case happens with inflation. So if you print more money, then the remaining money loses value, though at a minimal level. But if you keep on doing it, then you keep on lowering the quality. So as governments keep on printing more and more money, then money keeps losing its purchasing power. So if you have 100,000 Kenya shillings right now, and then you store that money, let's say under your mattress, and then you take that money a year later, then the amount of goods that that money will purchase will be a little bit less than what it could purchase right now. So the purchasing power of money is what erodes away in inflation. So one of the best ways to fight this inflation is to invest your money. So there's various platforms that you can invest your money in, either in traditional finance or in decentralized finance, or what we are calling DeFi. So the main purpose of this presentation today is to help you identify where you can invest your money to beat this beast we call inflation, because your money will lose its purchasing power over time. So as I already mentioned, there's a proof of work done. So if you work somewhere, you're getting paid in money. If you store that money and the government keeps on printing more money, your money keeps on losing value. So to beat this monster, then you have to invest your money, which is something like it's a necessity. It's not something you have an option about. You have to invest your money. So today we'll be looking at how you can invest either in DeFi, traditional finance, or develop a mix of both. So a deflationary currency, on the other hand, will have what we call a hard cap. A hard cap means that the total amount of currency in circulation doesn't increase at all. And this is the case with Bitcoin. So we know that there only exist 21 million Bitcoins, and that number will never exceed 21 million. And that's based on code. It's something that you can verify, and nobody will ever change that. So if Bitcoin is the most popular currency and invest in it, you know that the amount in circulation will never increase. On the other hand, if you look at the amount of Bitcoins in supply and also the demand for Bitcoin, you know it's growing. At the onset, let's say 11 years ago, there was a very small number of users in the Bitcoin space. But as we go year over year, then the number of users for Bitcoin keeps on increasing, and we have come to a level where an entire country is using Bitcoin as their main currency. And this is the case with El Salvador. So commercial banks are adopting Bitcoin. They are allowing investors to allocate some of their money in Bitcoin. And this is creating more and more demand for Bitcoin. So with the demand going up and up over time, and supply is not increasing, then this drives the price of Bitcoin up. And this has been the case over the past 11 years. Whenever you hear that a currency has a hard cap, it means that the supply will never reduce. Will never increase. So when we talk about deflationary currency, it's either there is a hard cap or the amount of supply of that currency keeps on reducing. So when we talk of reducing supply, we know there is what we call coin bans or token bans in the crypto space. So if let's say you're trading Ethereum and there is a certain amount of Ethereum in circulation right now, if the developers go for a vote and decide to ban a certain amount of Ethereum that is minted, then that coin ban will reduce the amount of Ethereum in circulation, which will make the currency deflationary by simply reducing the supply. So we shall look at what this means in terms of purchasing power. So a simple graphic representing the same is a centralized payment system where there is a central bank acting as the central authority, which is government governed by the government. Then we have commercial banks acting as the intermediary between you and the central bank. And then there is you as the end user of the currency. So if you want to send your money, let's say to a different person, then you have to go through the commercial banks, which is regulated by the central bank, and then another commercial banks for your money to get to a different person. So in a DeFi ecosystem, when you send your money from your account to a different person, then this is done directly through what we call a distributed ledger, or otherwise referred to as a blockchain. So as long as you have access to the platform, then you can simply send and receive money in a permissionless manner, and the transaction costs are often very minimal. So for instance, if you're sending, let's say, Binance coins, it will cost you like $1 regardless of the amount. So if you're sending $10 million, it will cost you, let's say, $1 or $2, and so on. So it's usually a very small fee. If you're using other chains, the transaction cost can go as low as 0.001 of a Kenya shilling. And this is just to send and receive money regardless of the amount that you are sending or receiving. So on the next part, we look at the major players in traditional finance and then compare these with the major players in the DeFi space. So I see there's a lot of questions coming in, so I'll be looking at this later. So hopefully in my presentation, I get to answer a lot of these questions. So the major players in the traditional finance are as follows. One is the education system. So the education system is a major player in traditional finance because this is how you get to know about the system and understand how it works. So it will help you as a learner understand the money, the debt, banking, and also investments. So as you go through the 844 or the current education system in Kenya, you get to understand what a currency is, what a bank is, insurance, and all that. And as you grow older, then you become part of the system. So you are basically introduced to the system right from a very early age. Let's say from class 1, you learn this is money, this is how it works, and so on. So the other major player is commercial banks, which will offer people savings as well as current accounts and also loan facilities. So from the commercial banks, this is where you make your deposits to save your money. You can run a current account where you make transactions, you send, receive money, make payments, pay bills, and all that. And also, if you want loan facilities, you want to borrow some money, then you definitely go to your commercial banks. And of course, we know that things are changing. If you look at the space in Kenya, fintech is improving commercial banks, where right now there's absolutely no need to visit commercial banks for any kind of service. You can access these through a mobile phone or even agency banking. So the other major player is insurance companies, which will help pool funds together to cover uncertain events. So insurance companies literally do one very simple task. They will identify an uncertain event. An example would be, let's say, a car accident or even death or even a personal accident. So they will pull people together, let's say 100,000 people, you contribute a small amount, and if something happens to a small portion of you, then you use that pool to pay that money. So if let's say you're contributing 1,000 per person to cover a car accident, then a car accident happens to, let's say, 30 people out of, let's say, 100,000 people, then that money in the pool is used to pay those people. And then the insurance company will invest the rest of the money and then make a profit for itself. So insurance companies offer some very good solutions to a very known problem, which is basically uncertain events, which can be very detrimental individually. So we also have investment banks and brokers, and these will literally help you access global financial markets. And this is where Scope Markets comes in as a broker to help you identify market opportunities, to give you a platform to make your investments in what we call stocks. And stocks are basically shares of companies trading in public markets around the world. An example, you'll be able to trade stocks such as Apple, Tesla. This is the New York Stock Exchange, the Nasdaq. At the same time, you'll access other markets. So I'll be giving you a brief introduction of the markets that you can access from the Scope Markets platform. Quick one, this will divert a little bit. So if you're trading, let's say, on a Scope Markets trading platform, this is called an MT5 or MetaTrader 5 trading platform. These are some of the assets that you can trade. So you trade shares of companies based in Europe. An example is French shares. Here is one of the companies that you can trade. This is Airbus. You'll be able to trade Carrefour. Carrefour is the retail chain. We also have these supermarkets in Kenya. You can invest in those shares. Christian Dior and so on. You'll have German shares, UK, Netherlands, Spain, Denmark, as well as this is Brazil's in Belgium. At the same time, you'll be able to access American shares. An example is Apple, Adobe. You will also have Yamana Gold, Alibaba, and so on. So you can literally access all these shares from the comfort of your phone. So fintech has really improved compared to traditional methods where you'd have to go to a commercial bank, open a CDS account, and all that. So with Scope Markets, you don't have to do all that. All you have to do is to go to your browser. So from your browser, you open a new tab, go to Scope Markets, and then register for an account. And once you register, get the account verified, and you can literally start trading stocks from the comfort of your home. If you need a link, it's right here. So if you ever want to check out our products, then this is literally where you start, register now, and then that's it. So that aside, back to the presentation. So other players include investment advisors and analysts. For I personally, I'm a market analyst, so we help serve the traditional finance space by helping people understand what financial markets are, how they can participate, and also how they can analyze the markets and identify opportunities to trade. So there's also what we call regulators, such as the Capital Markets Authority. They help make sure that there's an even playing ground for everyone. They will vet and license market players as well as secure investment accounts and protect investors from fraud. And this is one of the major advantages of traditional finance compared to DeFi because it's heavily regulated and it's much more secure compared to DeFi where the regulation is minimal. Though in future we're expecting there will be higher regulation in the DeFi space. So major players in DeFi include one, social media, the school of YouTube, as well as blogs. This is where you get most of the content as well as the webinars that we normally do. And this will help you as a learner understand what digital money is, understand debt, banking, and investments in the cryptocurrency world. Then we have wallets. Wallets serve as your commercial bank. In this case, you get to own your bank. You don't have to store your money with a commercial bank. You can simply download your wallet in your machine, let's say in your laptop, in your smartphone, and right there you have your commercial bank. You can save your money in there. You can do your current account in there, send, receive, pay bills, and everything from one simple wallet. So there's so many wallets that can accommodate a lot of cryptocurrency coins. So you would have to select among quite a big list. So hopefully, and in future, we'll be doing more of these sessions, and we will get to discuss the cryptocurrency wallets and how you select one of the best. So one key distinguishing factor is that there is what we call custodial wallets as well as non-custodial wallets. So custodial wallets basically means that your money is kept by a different organization. Non-custodial wallet means that you have your keys to your wallet. In this case, you have the total responsibility. So then we have what we call exchanges. They act as stock markets for crypto. They help people buy and sell cryptocurrencies. So we know that there is markets for fiat currencies, and these markets are mainly commercial banks and what we call forex bureaus. So if you walk to a forex bureau right now, you can sell your Kenya shilling for any other currency, or you can buy any other currency using the Kenya shilling. So if you go to a local commercial bank, you can buy euros, you can buy dollars, and so on. So on the crypto space, we have what we call exchanges. So on an exchange, this is where you can buy or sell a cryptocurrency against another cryptocurrency. So one of the major exchanges in the world is called Binance, and also we have other players such as Huobi, we have FTX, and so on. Then we have what we call P2p Escrow Platforms, and this is peer-to-peer escrow platforms. They serve as an entry point to the DeFi or to the cryptocurrency space. So these are platforms that will link the traditional finance with crypto. They help people convert their fiat currencies to crypto and vice versa. So if you have Kenya shillings, you want to buy Bitcoin, or if you have Bitcoin, you want to convert that to Kenya shillings, then you use a P2P escrow platform. The main advantage of having an escrow platform is because there is a third party that helps ensure that there is transparency of payments between two parties. So if you want to send some money to a guy, let's say some guy in Brazil, and that guy will send you Bitcoin in return, then you need an intermediary to make sure that nobody gets played. And in this case, this is why we use an escrow platform. So I will simply send my Kenya shilling to the escrow platform, and then the Brazilian guy will send Bitcoin to me. And once they send the Bitcoin to me and I confirm that, then the escrow platform will release the Kenya shillings to the Brazil guy. And that's basically how they work. So in Kenya, if you want to join the cryptocurrency space, then there's various platforms that you can use. An example is a Binance P2P platform. We have local Bitcoin's website, we have Paxful as well as Bitslato. And these are examples of websites that you can use to buy Bitcoin. And then once you get your Bitcoin, you can convert to any other cryptocurrency. So we also have investment advisors as well as analysts in this space. So generally venturing into these. So it's not something I've been doing. I've not been doing a lot of webinars on these. But this year remains a main goal to help educate people about the cryptocurrency space, the DeFi, as well as the traditional finance or what I've been doing in other platforms. We basically help people understand what cryptocurrency markets are, how to participate, and analyze the markets. Then we have a very key sector or a very key function we call the auditors or smart contract auditors. So as mentioned, in the traditional finance, we have regulators, government regulators such as the SISEC in Cyprus. We have the SEC in the US, which regulates the capital markets, and the CMA in Kenya. So in cryptocurrency world, there is no regulator, but we have what we call smart contract auditors. So since everything is automated in the DeFi space, meaning that if it's a smart contract for insurance, then everything is written in code, and if there is any kind of voting will be done through a DAO or what we call a decentralized autonomous organization, or literally a community that shares a bank account or a crypto account. So in this case, if there's a decision to be made, let's say it's an insurance product and you qualify for that product, then the people within the DAO will vote whether your claim is valid, and once they vote, then the money is released automatically to you. So to avoid any kind of fraud, to make sure that the industry is completely transparent, then DeFi projects will have to go through what we call a smart contract audit. So there's various organizations that will do this. They will assess the contracts for security as well as banks to make sure that it's not hackable. And these companies include Satic, which is very common. We have Slowmist. We have Hacken, which is literally the biggest smart contract auditor in the world, and also QuantStamp. So they will test a smart contract for vulnerabilities and give a rating or verification badge to show how secure a token is. So if a token has been audited by several companies, then it means that that token is very secure, and you can trust that when you are implementing your DeFi transactions. So it's a no-brainer. It's something that you literally have to do. If you're investing in a project, then you have to make sure that that project is audited, meaning that it doesn't have any kind of vulnerabilities. So they will help people distinguish between secure and unaudited smart contracts. So among all the fraud that has happened in the cryptocurrency space over the last, let's say, 5 years, if you are selective enough, you always invested in platforms that were audited, then you probably have zero losses, because if a contract is audited, then the chances are very minimal for a hack or any kind of exploitation. Then we have what we call DeFi platforms. And these platforms literally offer financial services such as investing, loans, leverage, market analysis, derivatives, insurance, yield farming, and staking. So I'm almost done. So apologies, it have taken longer. So there's the issue of stability and risk. So in DeFi, asset prices can be very volatile, and this is something that you have to be concerned about. So volatility is a two-edged sword, meaning that on one side it's an opportunity, on the other side it's a risk. So if volatility goes your way, you are benefiting from that. If it goes against your way, then you're losing a lot of money. So you have to be very careful when you're trading a volatile market. So the value of a token can easily go 100,000% in a year. Like you can 100 or even 1,000x your money within 1 year. And this is the case with cryptocurrency platforms such as SHIB. So if you have heard of Shiba Inu, this is literally what happened this year. The cryptocurrency gained massively in a span of 1 year, which created a lot of wealth for a lot of people. So it can also drop 95% in a month, meaning that you can invest, let's say, $1,000 in cryptocurrency, and then within a short period, let's say 1 month, your balance will be reading something like $50. So you have to be very careful when you're trading a volatile market. So this is one of the main risks and discouraging factors about DeFi. But all the same, as I mentioned, it's two sides. So on one side, you can gain a lot of money. On the other side, you can lose a lot of money. And it's a common thing in the financial markets world, whether DeFi or traditional finance. Whenever you take on a very big risk, then the potential for reward is very high. So it's a high risk, high reward market, low risk, low reward market. So to invest in DeFi projects, you have to do due diligence and risk money that you don't need right now. So if you're looking to make any kind of investment, whether it's DeFi or traditional finance, then always invest money that you don't need right now. So if it's money that you need right now, then that's not money that you can invest. And I'm talking about school fees. I'm talking about the money you use to pay your bills, money you use to pay your rent, your emergency fund, and all that. So all that money that you have set aside for things that you might need now, then you don't have to invest that money. However, if you have some money lying in a bank, inflation is eating that money away, then definitely you have to invest that money somewhere, be it traditional finance, DeFi. You have to get creative, do your research, and find avenues for investing that money. So in traditional markets, asset prices are relatively stable compared to DeFi. So in traditional finance, you're not going to meet an asset that is going up 100,000%, but you are going to see something that it might be considered normal, where let's say if you invested in the, let's say, S&P 500 index, then you could make, let's say, 20 to 23% in a year. This is what happened in 2021. This is last year. So for most of these markets, you might see something not so volatile. So you might see 10%, 20, 30, 50%, and so on. So, however, if you decide to use leverage, and leverage is used of borrowed money to increase your position, then in this case, it could significantly expand your risk exposure. So if you're leveraged, whether in a cryptocurrency project or if you're leveraged in a traditional finance project, then it basically increases your risk and also your potential for making money. So your opportunity will go up, at the same time your risk will go up, so be very careful when you're using leverage. So hopefully we'll also be doing a session on leverage, help you understand what leverage is, the good and the bad side of leverage, and how you can navigate in between. All the same, you have to learn fast and practice due diligence, do your research, and also fully accept your risk. So as more money flows towards DeFi platforms, which is what has been happening, so is malicious hackers. So when you're investing in cryptocurrency or the DeFi space, then you have to be very careful about malicious hackers. So there's a risk of a rug pull. You could be rug pulled any day. We all know what a rug pull is. If you're standing on a carpet, somebody pulls the rug on you, then you fall. So sometimes it happens in cryptocurrency projects. You invest in something, and then somebody just pulls the rug, and you fall. Your investment goes down to zero, and then they take away your money. So The best way to avoid a rug pull is to invest in projects that are audited. So if your project is audited by multiple companies, then the chances of a rug pull are near zero. So you must filter for audited smart contracts to reduce the risk of rug pull. So traditional finance is highly liquid and is well regulated, so the intermediaries cannot run off with your money, though they can largely benefit from commissions and transaction costs. So if you're investing in traditional finance, let's say you're buying shares of various companies, you're buying commodities such as gold and oil, then the regulation is usually very solid. Let's say brokers such as stock markets is regulated by the CMA. So in this case, the chances of you losing your money are minimal. So at the same time, there will be costs in terms of commissions. Every time you execute a trade, brokers will charge you a commission, and also there will be transaction costs when you are sending and receiving money. So that's an upside and a downside for both the platforms. So examples of DeFi investment vehicles. So if you want to invest your money in DeFi, this is some of the most popular ways. One, it's called staking. So as already mentioned, when you're creating new coins in DeFi space, you do this by minting. We don't do mining. Mining is for chains such as Ethereum, Bitcoin, and so on. But for creation of new tokens, it's done through minting. So minted tokens are based on a proof of stake algorithm, meaning that if you stake your money in a platform that offers DeFi products, then you can earn some rewards from that, or what we may refer to as block rewards. So buy a DeFi platform token, such as let's say PancakeSwap, and then stake it for rewards. So you simply buy some coins, and then you stake those coins in that platform, and then you get the rewards from that. So stake tokens are used to validate transactions on the network and receive block rewards. So an example with PancakeSwap, this was done as early as about 2 days ago. PancakeSwap is literally offering an APY, annual payout rate, of about 140.39%. So this basically means that if you buy, let's say, 10 coins, and then you stake them with PancakeSwap, if the rate remains relatively the same for an year, then at the end of 1 year, you will have 24 coins because there's a return of 140%, whereas your original 10 coins makes it 24 coins. So regardless of the value of that coin, you'll have 24 coins in your account times the value of each coin. So you can literally stake your money in most of these DeFi platforms. So main reason or main purpose for staking, as already mentioned, the staked tokens are used to validate transactions on the network, and they receive block rewards for validating those transactions. So the other most common method of investing in the DeFi space is yield farming. So yield farming refers to providing liquidity in an AMM exchange to earn transaction fees. So when it comes to exchanges in the cryptocurrency space, it's not like traditional finance. In traditional finance, we basically use a book where you match buyers with sellers. So if you're buying a currency in the forex market, then you have to meet a seller. So if you go to your commercial bank, let's say you want to buy some Japanese yen right now, then the commercial bank will find a seller in the market and then link you up. So yes, you will be served directly, but at the back of the book, you are basically being linked to a Japanese yen seller. So in the cryptocurrency world, everything is automated. So we basically create what we call liquidity pools. So in a liquidity pool, such as this one, the big circle here, investors in the market, or what we call liquidity providers, will provide liquidity in this market by doing one of the following. So you'll buy a token, let's say PancakeSwap, and then buy another token that you can use to trade in that platform to make it a pair. In this case, let's say we use BNB or the Binance coin. So if you buy BNB or BSC, what you call Binance Smart Chain coins, and then you pair that with, let's say, PancakeSwap, you have to buy an equal amount. So you buy $500 worth of, let's say, BNB and $500 worth of PancakeSwap, and then you stake that money on this liquidity pool. So this way, if a person is buying a currency from that liquidity pool, let's say they are buying PancakeSwap, then they will have to give Binance to the platform. If they are buying, let's say, by BNB using the token, then they leave the other currency on the liquidity pool. So this way, you make what we call an AMM, automated market maker platform, where every participant can buy and sell that currency. So if there is no liquidity, then there will be no market. So the liquidity providers will get rewarded for the transaction costs. So if you go to such a liquidity pool, let's say you buy a cryptocurrency such as PancakeSwap, then you'll be charged a transaction fee, which is distributed to the liquidity providers as the profit for their for providing that liquidity. So yield farming is very common in the DeFi space, and it helps a lot of participants to make a lot of money in this space. So that being mentioned, we have seen the examples of DeFi investment vehicles, and also we have lending and borrowing, which basically refers to providing liquidity for other people to borrow at an interest rate. So you can definitely provide money in the platform, and once people borrow that money to do whatever they want to do, then they will pay back with interest, and you get to benefit from that. So I believe that was the last slide. So I know I've taken so much of your time. So one last thing before I complete my presentation, I did 2 days ago in preparation of this. So decentralized finance or DeFi platforms, thread. So this is what you currently do in DeFi and on what platform. So I did like 7 examples showing you various platforms that you can use. So the very first example here is AAV or AV. So it's an open source decentralized non-custodial lending protocol used to create a crypto market where users can borrow tokens and earn compound interest in the form of AAV, formerly known as lend tokens. Current APY is about 8.62%, meaning that if you invest your money there and you just lock it there for a year, then the reward is about 8.62%. Then we have Compound, which is a crypto market for borrowing and lending assets, which can adjust compound interest rates through algorithms and obtain comp governance tokens. It's audited and reviewed to ensure the highest level of security standards. So OX, which is a cryptocurrency token on the Compound platform, has a current APY of about 8.93%. So in this case, if you just buy Compound and then you stake on OX, then you make 8.93% in a year. So we also have PancakeSwap. I already mentioned this, so skip that. Then we have Venus. Venus enables world's first decentralized stablecoin, VAI or VAI, built on the Binance Smart Chain platform that is backed by a basket of stablecoins and crypto assets without centralized control. So the beauty about Venus protocol is you stake on a stablecoin. A stablecoin is a coin that is pegged on a fiat currency. So in this case, if you use BUSD, this is Binance USD, it's pegged on the value of the US dollar. So this one will not have that volatility as mentioned with other currencies such as Bitcoin, Ethereum, or any other cryptocurrency. With stablecoins, they maintain the value because they are pegged on the value of a dollar. So in this case, if you stake BUSD on Binance platform, then the current APY is about 7.61%, and this is quite some good return, tax-free, and so on. Then we have Balancer, which is an automated portfolio manager and trading platform. Its liquidity agreement is known for its flexible staking. It doesn't require lenders to add liquidity equally to both pools like in DX platforms. So this one is a platform that where you can use to invest in other cryptocurrencies and then create a portfolio based on that, and then you'll be getting aggregated rewards. We also have Bridge, which is a tokenized risk protocol that allows users to hedge against yield sensitivity and price volatility. It does so by accessing debt pools and other DeFi protocols and creating multiple assets within a single debt pool within varying risk and also return characteristics. So this one will allow you to hedge against yield sensitivity and price volatility. So if you feel like your investment is exposed to risk volatility, then you can do some hedging using the Bridge protocol. So we have SushiSwap. I know it's difficult to pronounce, especially for me. So it's a branch of Uniswap, which caused huge waves in the community during its liquidity migration. So this is one of the original DeFi platforms, which branched from Uniswap on the Ethereum blockchain. So SushiSwap is now a DeFi ecosystem with a multi-chain AMM, automated market maker, leverage, and also loan markets, on-chain mini dApps, and launchpad. So key thing here is leverage, meaning that you'll be able to trade cryptocurrencies on DX with leverage, meaning that you can increase your position multiple times and this can increase your potential for making money and also the risk that you take. So we also have what we call abracadabra money, uh, otherwise referred to as a spell. Yes, that's the name in case you are confused. TVL, or the total value locked in this platform, is about $6.15 billion. So it's a spell book that allows users to generate magic internet money or tokens. So Abra uses what we call Cashy technology, which has been audited and runs on a bento box platform. So you can check that out when you're available. I'll be sharing the link with you guys. So I believe there's more. There's Open Ocean, which is the world's first full aggregation protocol for crypto trading that sources liquidity from DeFi and CeFi markets and enables cross-chain swaps. So basically, what this platform does, it will combine both the CX or centralized exchanges such as Binance and FTX with decentralized exchanges such as SushiSwap, Uniswap, PancakeSwap. Once you combine all this liquidity, then it creates one big ocean where there is a lot of liquidity. So if you're looking to buy a token, you get the best prices from the lowest seller. If you're looking to sell a token, then you get the best prices from the highest bidder. And that's it. So last platform, I will not be taking much into this, is the One Inch Network, which is an innovative and flexible limit order functionality in DeFi. So it's also an exchange that helps you buy and sell cryptocurrencies, but the advantage is that it has limit orders compared to other platforms. So this marks the end of my presentation, and then we'll be looking at the questions that you have raised.
All right, great. Yeah, thank you so much, Rufas. I think that was an awesome breakdown. I see a lot of enthusiasm on the chat section. I see people really, and I think you really broke down the topic really well. So thank you for that nice breakdown. I see you've answered a lot of questions. I see a few more here. I don't know if you can pick a few more. There's one question here. Yeah, there's someone asking just the latest question. Maybe you can start with that, Rufus. Explain more on hedging, both in traditional finance markets and DeFi.
So when you talk of hedging, it's basically protecting your investment from market risks. For instance, let's say you buy a stock in the Nairobi Securities Exchange. Let's say you go for the banking sector and then you buy an Equity Bank share. So you're basically exposing yourself to the risks associated with that individual company. So if something was to happen to that company, then your investment could be affected significantly. So if you can find an asset that has a correlation with that asset, then you can take an opposite side kind of trade such that when one increases, the other one reduces. So this way, if something was to happen to Equity Bank and Equity Bank goes down, then we know that there is other assets that could be affected in a different way. So let's say you go for KCB. So we know that the chances of Equity Bank crashing and KCB crashing at the same time are much more minimal. So if equity was to crash right now, then a lot of customers would go, let's say, to KCB. So in that case, you can, let's say, take a position in equity and another position in KCB. So if one happens to go down, then it benefits the other one. So it's much more simpler in currencies because there is a much more stronger correlation. So if one currency is going up, then there's a currency that will probably be going down. So if you take an opposite kind of a position, it means that you're protected yourself against that risk. So in cryptocurrencies, it's the same. For instance, right now, we know that Bitcoin has been going down for the past couple of days, and this has been taking all other coins down. Okay. So if you had a net buy position in Bitcoin, and then you enter a short position, let's say on Ethereum, then you know that when Bitcoin is going down and taking Ethereum down with it, then you'll be making a profit from your sell position on Ethereum. So this will cover your losses in Bitcoin. So hedging is literally protecting yourself against a certain risk that could be affecting a certain asset.
All right, thank you. Breakdown, Rufus, and maybe along the same lines, I see another question similar. So someone is asking, is there insurance in DeFi covering losses or fluctuations or crash?
Yes, there's insurance platforms. There's insurance protocols that offer you a cover. So you can enter into an insurance product. So with an insurance product, you literally get the normal kind of insurance that we usually have in the traditional world. So that's one way of looking at it. On the other hand, if let's say you're investing in Bitcoin and you're looking to insure your position, I don't know of any product that offers that. So yes, with Binance product, we all know that there is a lot of exchanges around the world. So if you're investing using the Binance platform, that platform is insured against any form of risk. So if the platform was to be hacked and you lose your money, then the Binance platform covers that. But other platforms do not offer that. So you'd have to do your due diligence and then find the platform that has insurance. They normally do so in form of a fund. So I believe Binance has a $1 billion fund set aside to cover against such a risk. But other platforms do not have that. You have to research on individual platforms to know whether they have a fund for that.
Okay, thanks for that. Yes, indeed, Binance does have insurance. I think they call it SAFU.
Yes.
Along the same lines as well, Rufus, someone is asking then, which is the best wallet to store crypto and avoid hacking?
I wouldn't say there's a best wallet because different or multiple wallets serve different functionalities. So one of the most common wallets that is very, very secure and hackable is the Binance wallet. What do we call this? Trust wallet, yes. So if you have Trust wallet, I believe that that's good. I also have the Engine wallet. It's very solid, and also MetaMask. So if you're a beginner, then you can start with one of those three: Engine or Trust wallet or even MetaMask. So one key thing about the three of them, they are non-custodial, meaning that you own your keys. So there's a very common term where we say if it's not your keys, then it's not your coins. So for the three wallets, they are non-custodial, meaning that you'll have your own keys or your own security to your wallet.
All right. Edward is asking, what do you think about hardware wallets like Ledger?
Hardware wallets are very risky. I think they are very risky. One key risk is about the size of the blockchains. So traditionally, back in 2013, 2014, you would literally download a full node and then keep your coins there. But right now, unless you have a very secure platform, a very secure machine, and your hard disk are well maintained, then you can go for a hardware wallet. But right now, I believe the best way, just go for a non-custodial wallet, because even if your phone crashes, you can download the same app again, log in, and you'll have your keys and everything.
So Ellie is asking, what are your thoughts on more countries accepting crypto as legal tender?
I believe this is something that is bound to happen. If you look at El Salvador, they basically adopted Bitcoin mainly because of the solutions that Bitcoin is providing for them individually. So for the country, a lot of income comes from exports. They export a lot of labor. So a lot of people born in El Salvador work outside El Salvador, mainly in the US, Mexico, and other countries, and they have a lot of difficulties remitting money back to their country. So to solve this, they implemented the Bitcoin currency to make sure that people can seamlessly send money back home in a way without having any of those challenges. At the same time, they did not have a currency. They depended on the US dollar as their main currency. So whenever the US would print more money, the US central bank would use that printed money to implement infrastructure and other projects in the US, but they would not be doing so for the people of El Salvador. So they felt that they were deceived, so they had to implement a different currency. So when it comes to other economies adopting Bitcoin, it will be based on their unique needs. So for instance, we know what's currently happening in Turkey. They have a very high inflation rate. Their currency is almost collapsing. So Bitcoin is literally serving as a store of value and also a store of stake. So in this case, to protect your money against inflation, then it's a need to buy Bitcoin. So if you look at Argentina, something similar is happening. So if there will be adoption of cryptocurrencies, it's based on individual needs of each country. So if you feel like your currency is not working, then Bitcoin is a ready solution.
All right, great. I mean, and along the same lines, Rufus, when you look at regulation, for example, here locally in Kenya, where do you see that happening? When can we expect, say, scope markets to? I know currently they will not allow you to trade crypto, for example. When can we have that? And I know it has something to do with regulation.
So in Kenya, we have been having that challenge. I believe the responsibility is on our side, the major players in the cryptocurrency space. Me, myself, you, and other players in the market. we need to push these guys to recognize the need for allowing a regulation platform or a regulation framework for the cryptocurrency space. So if you don't push, you don't get any results. Because literally, these guys are not willing to learn about cryptocurrencies. They don't have a formal structure where they can go and learn and understand the platform. So if we don't push the regulations to them, then we'll have to probably rely on another framework that is done on a different country and then implement it here, just like we did with forex. So previously, there was no regulation for forex brokers, but the regulations we currently have are copied from a different currency country, and then you adjust those regulations to fit the economy, and then that is implemented. So hopefully, if we are able to push, then within a short period of time, you can have that framework implemented.
Right, great. Thank you for that breakdown. And I think due to time, maybe I would like to ask, there's so much to learn, and I see there's a lot of interest in this space. Likely, this interest will continue in 2022 as DeFi and the crypto space grow. What, I mean, where can people go to learn more from you? Are you looking to do more classes like these ones?
Currently, I'm doing physical classes on the Scope Hub website. I'll share these. So if you're interested in learning anything about traditional finance, and this is how to trade stocks, forex, commodities, I normally do this on a daily manner. So I do this on a platform called Scope Hub. So from this website, I'm going to share this on the live chat. It's called Scope Hub. So this is what I'm doing next week. On Monday, I'll be doing introduction to trading in the financial markets. I literally introduce you to the financial markets and how you can trade them. Tuesday, getting started with technical and fundamental analysis. Wednesday, we'll be looking at live stock market analysis. And this is not the Kenyan stock market. My main focus will be on the US as well as European stocks. And lastly, we have a price action trading episode 1. This is a new series that we are starting this year. So on Thursdays from 4 to 5 p.m., all you have to do is register. It's completely free. We don't charge anything. And on this platform, we'll be doing price action trading of currencies. We'll be looking at stock market indices such as the S&P 500, the Dow Jones, and also the Nasdaq, and as well as oil markets and metals such as gold and silver. So this is literally what I'm doing on each and every day, training people, helping people understand, break down information. So let's say there is some form of news happening around the world, we break down this information into actionable intel where you can identify trading opportunities and make money from the financial markets. So in terms of the cryptocurrency space, I'll be doing more of Twitter spaces. So kindly follow me on Twitter and you'll be getting more updates from these.
All right, great. Yes, I think Rufas's Twitter handle is posted there. Maybe I can
Rufas
ask.
KE.
Yes. Kindly, if you can repost it again, Rufas, if you don't mind, so that at least people can get to follow you. And as we wind up, Rufas, maybe I always like to ask this, advice to someone who's getting into the space for the first time, that sage advice that you always give to people.
If you're looking to join the cryptocurrency space, the DeFi space, then the basics are very simple. The very first thing that you need to do is to get education. Invest a lot of time in learning. So there's 2 simple books that I would really recommend everyone in this space to go through. So the very first book is called How to Bitcoin. I know the title is a little bit weird, but it's called How to Bitcoin. So this is the book, How to Bitcoin. If you find this, then you know the basics of blockchain, what Bitcoin means, and literally all the basics that you need to know about Bitcoin. The next book I want you to go through is called How to DeFi. So How to DeFi, this is the next book that you need to go through. Once you learn these, then there's literally nothing that somebody else will bring to you. Nobody will be able to lie to you about a certain project. You'll know what to look for, when to look for it, and where to look for it. So once you go through the education, second step, get out of debt. You cannot invest when you're in debt. And I'm not talking about large-scale debt. These minimal debts that we normally take on our mobile apps, local banking, get out of debt, manage your debt situation, and once you are out of debt, then you can start your journey to investing. I'm hoping I've answered that question.
Yes, I think you have. Thank you for that. I especially like the second one. Um, yes, um, I think that was quite informative. I think all of us have learned quite a lot from you. We look forward again to having you back, Rufus. I think there's so much we cannot cover everything in one session. You did highlight a few things that you probably would like to cover. So we would love to possibly have you back again at some point, hopefully this year, to continue this discussion. But otherwise, thank you so much for joining us today. We really appreciate it.
Thank you very much, David.